Welcome to my YouTube channel. My name is Michael Mansaliova. Today's presentation is based on a worked example. Where we're going to look at taxation of partnership part 2. The example we're going to deal with is as follows. Shed and Belt were in partnership, sharing profits and losses in the ratio of 2 to 3 respectively, with each entitled to a salary of 40,000 kwacha per month. The partnership accounts were prepared annually to 31st December. On 1st April 2023, Tai was admitted to the partnership, and with effect from that date, the partnership agreement was changed. Profit and losses and partners' annual salaries were to be provided as given in the table below. It is this table which showing Shed, Belt, and Tai. That is salaries per month changed to 32,000, 30,000, and 28,000 respectively, whereas share of balance of profit and loss will be now at 5:3:2. Then the partnership profit and loss account for the year ended 31st December 2023 was as follows. So we are given the income statement where there is a gross profit of 377,470, bank interest received 6,000 kwacha, profit on disposal of non-current asset 43,072. Then the expenses were wages and salaries, and take note that there are notes provided. Wages and salaries, there is note 1. We're going to look at how we use those notes. That is for the figure of 128,650 for wages and salaries. Then we have rent, and we have a note 2, that is for 84,290. Then we have repairs and renewals. There is a note number 3. The repairs and renewals accounted for 15,880 kwacha. Then we have electricity. There's note 4, 2,515. Legal expenses, note 5, 4,215 kwacha. We also have motor car running expenses. There's a note number 6 of 6,250. Then depreciation of 8,150 kwacha. We have also provision for income tax 10,180. And we also have under expenses miscellaneous expenses with a note number 7 amounting to 12,140. So the total expenses came to 272,270. Knocked out from the total revenue, the partnership declared a profit of 154,272. Now, when you are working out a problem in partnership, you notice that there will be additional notes or additional information, meaning that as you proceed looking at the items in the income statement, please don't forget to be counter-checking with the notes under that, because it will affect how you are going to determine the values to put in your answer, okay, or in your solution. So we have several notes given all the way up to note number 8, okay, all the way through note number 8. So what are we told to do? What is our task? Our task is looking at A, calculate the partner's tax adjusted business profit for the year ended 31st December 2023 between the partners, that is 10 marks. Then B, calculate the amount of business profit on which each partner will be assessed for the year ended 31st December 2023. To this one, I also add the third one. I want to demonstrate how you determine the tax liability for each partner. That is supposed to be part C. So we are going to go further than this. We are going to look at part C, where we are going to calculate the tax liability of each partner for the charge year 2023. So how do we go about this computation? So I start with computation of partnership tax adjusted profit for charge year 2023, which is part A of our tasks. So we have reported profit, which we're going to get from the income statement. The income statement provided tells us there is reported for 154,000. So 154,000 the reported profit. So net profit as per account 154,272 to be exact. So you put it there in the template. Then you have to adjust this profit to tax adjusted profit. Okay, so there are two types of adjustment. Either you are adding or you are subtracting a figure from that net profit as per account. So we normally look at the template in this manner. We normally present it in this manner, where we put what is to be added first, and then later on we look at what will be subtracted, so that it's neat and orderly. Okay, so let's go back and look at the income statement. Okay, so in the income statement, what we have is on the expense side, we have the figure of wages and salaries, which is note number 1. Wages and salaries, there is note number 1. Wages and salaries is 128,650. What does it say? Okay, go to note 1 to guide us. What is there? So note 1 tells us that included in wages and salaries are partner salaries of 40,000 for shirt and belt each. Okay, shirt and belt. Okay, now it's supposed to be, let me look at this one. Let's make shirt and belt, shirt, supposed to be shirt. Let me look at this in this manner: shirt, belt, and tie. Okay, and tie. We put it that way. But tie. Okay. Yeah, that's okay. That's what we have. So okay. So if that's the case, then what did we do? Or what did I do on this one? So we know that when it comes to the rules of deductible expenses, what expenses are going to be allowed or disallowed, we are guided that where the owners pay themselves or draw something from the business, in this particular case salary, that is it going to be taken as an appropriation of profit. An appropriation of profit. Therefore, that type of expense is not a deductible expenses for the purpose of calculating the tax, income tax. So we add back. So how do we add back? On this particular situation, be very careful and know that there are 3 partners for the whole year to be considered, where the 2 partners, which is shirt and belt, were there for the first 3 months, and then the partnership changed the agreement, whereby they admitted the 3rd partner, who is tie, and conditionalities changed, including salaries. Now, those salaries are quoted as annual figures. Those salaries are quoted as annual figures. Like this 40,000, that is for belt and tie. Okay, we also have salaries when the partnership change, which is 32, 30, and another figure for tie. Okay, so in fact, when you look at this to be exact, let me just say that these wages and salaries included partners' salaries. Partners' salaries. So, the reason for that, I don't want to make you mixed up. So we're going to look at this particular situation in this manner. So now, how do we deal with this given that these are annual figures? So we do look at a working relating to that. We look at a working relating to that. Partners' salaries. Okay, so there was for January to March, when the partnership ran with two partners in the name of shirt and belt. So the partnership ran with two partners, shirt and belt. Now this 40,000 is for 12 months. So January to March is only 3 months. Then it means we have to account for only 3 months salary for shirt and belt. So 3 out of 12 times 40,000 gives us the 10,000 for shirt and also 10,000 for belt. Since these were getting salaries of 40,000 each, these were getting salaries of 40,000 each as given here. Okay, first sentence, they are getting a salary of 40,000 each. So that's why we have considered this particular figure, 40,000 for shirt and belt. Find 3 out of 12 months, that gives you 10,000 each. So that's what we consider there. Okay. Now, in this particular regard, we also look at the other salary from April to December, where the partnership had another partner coming, tie. So looking at that, you notice that when the partnership changed, the salaries also changed. We have 32,000 for shirt per annum, 30,000 for belt per annum, and 28,000 for tie per annum. Now, this April to December is 9 months. So we are going to apportion that to extract or to obtain the salary that each partner got in the 9-month period. So we have 32,000, 30,000, 28,000 multiplied by 9 by 12 each. Then we're going to get for shirt, it will reduce to 24,000, that's a 9-month salary. Then for belt, to get 22,500, for tie, 21,000. Okay. So now, what happened in this particular case is that it means that for the charge year 2023, on account of shirt got a total of 20,000 plus 24,000. That is 34,000. For belt got 32,500. Tie got a total of 21,000 because he came, or this partner came in the last notional period, which is 9 months. So that's what we have. So if you add this, you are going to find that it is going to give a total of 87,500. 87,500. These are salaries which partners drew from the partnership. So since these are taken to be appropriation of profit, they are supposed to be added back. They are supposed to be added back. So you find that in the solution then, in working out this particular example, the solution, the partner's salary, the total of 87,500 is added back. So I've made reference to working one where the 87,500 was worked. Okay, so that's what we have. Then also in this particular situation, we are told that there was rent and rates. So rent and rates of 84,290. We go look at the note. What does the note number 2 tell us? What does the note number 2 tell us? Go look at what does the note number 2 tell us. Tells us that 1/3 of expenditure on rent and rates relate to rent paid for houses occupied by 3 partners and their families. So meaning 1/3 is private expenditure, which is covered by the partnership. So expenses to be deductible should be wholly and exclusively for business. So this component is private, means that it has to be added back. So it has to be added back. So go look at how we treat this one. We have rent, 1/3 of 84,290 has to be added back. It is disallowed. It is disallowed. So that's what has happened there. It is disallowed expense for tax purposes. Okay, so that's what we have. Then we look at what is the next. In the income statement, we are given to say we have repairs and renewals. So repairs and renewals, there is a note number 3. Note number 3 tells us repairs and renewals. The charges in the profit and loss account includes 3,000 incurred on fitting fire safety equipment in the factory. Okay. Now this is a capital expenditure, and the Income Tax Act clearly states that for expense to be allowable, there should be revenue and not capital in nature. So therefore, this disallowed expense is the capital expenditure we add back. So go look at this one. It is added back. So we find safety equipment 3,000 and the additions added back 3,000. Then we go on look at the income statement. What next does it give us? It tells us that there is electricity of 2,515 and there's note 4 attached to that. So what does note 4 tell us? Okay, so this is a breakdown of the 2,515 kwacha. So there is electricity for partners' salaries. Okay, the administrative and factory. Okay, should be partners' houses. Okay, partners' houses. Let me just clarify this one. Partners' houses. Okay, that's fine. So partners' houses, meaning the business, the partnership was paying even for private home, which is non-business. So for expenses to be allowable, it should be wholly and exclusive for business. So since there is a partners' housing involved, it means that we have to actually remove it. What is the figure? It's supposed to be 691, which is supposed to be added back. It's not an allowable expense. It's not a business expense. So we are going to add it back. So we have partners electricity 691. Then we go back to look at the next item. We have next item, legal expenses, and there is note number 5. Legal expenses amounted to 4,215. So what does the note number 5 tell us? So the breakdown of legal expenses is given by this. The defending action in respect of alleged faulty goods. There is cost in connection with acquisition of new 55-year lease. There is also defending shed in connection with speeding offense. Okay, so now we have a number of these. So to start with, defending action in respect of alleged faulty goods. This is the tax authority or the income tax act does not encourage illegalities. So since this is bordering on illegality, it simply means that this defending action in respect of faulty goods needs to be disallowed. Then also there is cost in connection with acquisition of new 55-year lease, 1,200. Again, that is a capital expenditure. This particular cost is at the start. So this type of legal cost is capitalized, and the rule tells us that for expenses to be allowable, they should be revenue and not capital in nature. So since this is a capital expenditure, it is disallowed, added back. Again, there is defending shed in connection with speeding offense. Again, this is an illegality. You are going to have this one disallowed. So this one is also disallowed. So we add back. So we add back these three. That's what we're going to do. We're going to add back these three. So defending action in respect of faulty goods. So we go back. Okay, faulty goods. Okay, so we have 1,150, and also defending action in respect of speeding offense, including let me just include this one. Then capital expenditure, acquisition. That is, I just say 55-year lease, 55-year lease agreement, which is a figure of 1,200. 1,200. Okay, 1,200 is also disallowed. It is also disallowed. So meaning this changes the total figure here. Okay, changes the total figure. We're going to have 1, 2 included here. So this one will change to 4, 5, and this one will be 0. But we have added 1,200 on top there. Okay, so if that's the case, then it means that this figure will also be increased by 1, 2. So it will be 50 here, 50, and we have 202 here. Okay, so because of the additional 1,200, equally this one, it's up by 1, 2, 1, 2, and this one is the 6. Okay, so that's how it is done. Okay, fine. So that's how we are going to make that adjustment regarding the legal fees. So we go back and find out what else is there in the income statement. The income statement further leads us to look at motor running expenses, 6,250. 6,250. So 6,250, what happens with 6,250? Let's look at the effect of note 6. So we check what note 6 will tell us. Note 6. What does note 6 tell us? Okay, note 6 tells us that the partners use their own private vehicles in partnership business. business mileage as a percentage of total mileage done by each partner together with the total motor carrying expenses are given below. So you have this. So it says Shet used his car, or this partner used the car, 75% for partnership business, and Belt 80%, Ty 60%. Okay, so meaning for Shet there is 25% non-business. Okay, for Belt there is 20% non-business. For Ty there is 40% non-business. So that's what it is. And for expenses to be allowable deduction, they should be wholly and exclusive for business. They should be wholly and exclusively for business. Then it means that we are going to work out the 20% portion of it, or 25% for Shet of the 2,210, and the 20% for Belt of 2,150, and the 40% for Ty of 1,890. Okay, of 1,890. These need to be added back because they are not business expense. They are not business expense. So let's look at the little working that needs to be done in respect of extracting these figures. The little work that needs to be done in respect of extracting these figures. Okay, these figures. Okay, here we are. So computation of capital allowances for charge year 2023. Not capital allowances, but I'm looking at figures for. Did I do that? Okay, no, I did. Yeah, okay, I did that. So that is for these are capital allowances. The calculations were done on the face of the presentation, the presentation which I made for this income. I didn't do a separate working, not a separate working. So let's look at how it was done. Okay, how it was done. Okay, here we are. So Shet, we have 2,210. So meaning that since 75% was used for business, the other portion was used for private, which is 25%. So 25% of 2,210, you get 553. Equally or similarly for Belt had used the car 80% for business, which means 20% balance was used for private. So that is also added back. Then we come to the other one, that is Ty. Ty had used 60% business, meaning the other part for Ty, the other part for Ty, let me just make adjustment to this one, for other part for Ty, okay, the other part for Ty, which is still not showing. Let's see. Okay. For Ty. Okay. Okay, fine. I think it will give us something like that. Okay, wonderful. Okay, so here we are. We have Ty also of the 1,890. 40% is non-business. You add back. So these are motor running expenses which are non-business. Okay, they are private. Okay, so we add back. So that's what we have seen there. We go on to look at the next in the income statement. What does the income statement tell us? So we go back and we see that we are told that there is depreciation of 8,150. Okay, so depreciation is specifically disallowed. Okay, depreciation is specifically disallowed. Instead, the Revenue Authority gives a relief to a taxpayer in form of capital allowances, which we are going to deal with later on. Okay, so it means that if it is disallowed, it is also added back. So you see how this one is added back for depreciation. It has to be added back. So we have to add back depreciation. So this is what was included here of 8,150. 8,150 added back. So what the next item to be looked at, we go back to the income statement. We find says provision for income tax 10,180. Provision for income tax 10,180. Just like before, we take note that for provision for income tax expense is not an allowable deduction, so it is added back. It's not an allowable deduction, so it is added back. So we go and see how this one is dealt with. We see provision for income tax 10,180 added back in this regard. Okay, added back in this regard. Okay, so when we add that, what we are going to have, this one added. Okay, we have 145,072. That is the total of expense additions. Okay, total of additions. So total of additions. Then there are also other things which are disallowed income. Disallowed income. When you look at the income statement, the income statement does provide us with these inclusions. There is bank interest received and profit on disposal of non-current assets. Bank interest, that is an investment income. And investment income are subject to withholding tax, so they are taxed differently. So they are not supposed to be part of this computation for income tax. They draw a different tax, which is a withholding tax, and they're taxed differently. So you have to remove this, okay, from these incomes, not taxable income for the purpose of income tax computation. Equally, for profit on disposal of non-current assets, okay, profit on disposal of non-current assets, when you sell off a non-current asset, probably you are not even in the business of selling those because they are not part of your goods, okay. So that is a capital item, okay. That is a capital item. They are taxed differently. So they are not supposed to be part of this particular computation of income tax. So they are subtracted. So you deduct. So these two will be deducted in our computation. So you see that in this particular case, we are going to have bank interest received 6,000 and also profit on disposal 43,072. These two added, 49,072, being a subtraction. So you subtract this. This is subtracted. This is subtracted. Okay. When you subtract that one, remain with it. 250,272. So we have from above here 154,272. We add 145,072. We are going to, and then subtract 49,072. We are going to remain with 250,272. This is tax adjusted profit before capital allowances. Now, there is an addition subtraction that is need to be made, that is the capital allowances. As you can see, this states tax adjusted profit before capital allowances. Then we need to determine whether we have any capital allowances. Working number 2 takes us to that. Working number 2 takes us to that. So let's look at working number 2, which takes us to that. Okay. So now we have shirts, belt, and tie cars. For these cars, they were bought for shirt. They were bought in 2022. Look at that particular note, which gives us that information. Let's look at when they acquired these cars. When did they acquire these cars? Okay, want to look at when they acquired the cars. Okay, here note number 8, we are told that Shed acquired a car on 1st October 2022, but we are in 2023. Then Belt acquired this car on 1st November 2022, we are in 2023. Tie acquired it way before, on 1st April 2021. Okay, now these are cars. And for capital allowances, cars these are non-commercial vehicles. They attract a 20% capital allowance per annum on the original cost. So these are the original costs. So what we are only bothered about is the original cost. And for each charge year, like 2023, you are supposed to get 20% to claim capital allowance. Okay, 20% to claim capital allowance. Okay, so that's what we have. So that's what we will look at in the workings here. Okay, so this one, 14,000 for shed, capital allowance 20%. Now remember that this car was only 75% used in business, so we are only going to claim the business portion. So you have to get 14,000 times 20% capital allowance, then get a proportion, business proportion, which is 75%. You're going to arrive at 2,100 on account of Shed's car. Then we have Belt's car, is 15,000 original cost, capital allowance, non-commercial vehicles 20%, and this Belt only used it 80% for business. So we're going to get the business proportion that will lead us to 2,400. Then Ty's car cost was 18,000, capital allowance non-commercial 20%, and use it for 60% business. So you get 60% portion, you get 2,160. So the total from these cars will give us 6,660. But we are given under note 8 that there were other asset capital allowances. Other asset capital allowances. Other asset capital allowance. Capital allowances on other assets held by the partnership were 12,000 for the year ended 31st December 2023. So meaning that we have to add that. We have to add that. We have to look at what is the total capital allowance. So having from cars 6,660 plus other capital allowances from other assets 12,000 gives us a total of 18,660. 18,660. So that's what is the total capital allowance. So the total capital allowance is a relief. It will be used in the computation of tax adjusted profit. Okay, so we're going to knock it off from that figure. So we have here Capital allowances working number 2, where we got 18,660, knocking off from 250,272. We remain with tax adjusted profit for capital allowances 231,612. 231,612. So that is the figure that we have. That is the figure that we have in this particular case. So now we're going to continue later on and look at how do we calculate, how do we determine how much is supposed to be accessible under each partner. Okay, remember there's a tax through income through system. When it comes to partnership, the partnership firm itself does not pay tax. Who pay tax? The partners. So we are going to see now how this figure is supposed to be. We're going to see later how this figure is supposed to be shared by the partners. So that's the next we're going to look at. For now, look at this. In the next video, I'm going to show you how that is done. And I think for this presentation, we end here so that you kind of assimilate what we have done so far. You kind of assimilate what we have done so far. So thank you for listening. I hope to see you in the next video. Please like my video and subscribe to my channel for you to continue benefiting. Thank you for listening.